Hello, this is Dean Jenkins with FollowMeTrades.com for the week coming up of September 6, 2015. And like I did last week, I'm going to start off by taking a look at some of the headlines and just having some fun and making a few points. I got good feedback from people last week that they wanted me to continue doing this, so send your comments. It always helps shape what I'm doing. So here's some headlines from Tuesday, September 1st. U.S. stocks tumble as China slowdown deepens concerns on growth. That's from Bloomberg. Uh-oh, the Dow falls 400 points on more China fears. And final headline on Tuesday, Wall Street slumps as weak China data stokes growth fears. We're going to talk a little bit about China growth here in just a minute. Wednesday, September 2nd, sorry, China investors, Shanghai stocks are falling again. I just thought that was a cool headline. Here's the first line of the article. There is no rest for the wicked or the China investor. That was funny. I just threw it in there. And after steep Dow tumble, Asian and European markets hold steady. Oh, good. Got some steadiness. This Friday, today, Dow plunges more than 200 points. Then they updated the headline a little bit later. So 300 points after jobs data. And stocks drop as mixed jobs report keeps investors guessing. And what we're guessing about here is the timing of the Fed raising interest rates. Here's the headline of the week, I think, and here it comes bouncing in here. From Fortune on Wednesday, September 2nd, and the question they were asking in the headline was, will the crisis in China sink the U.S. economy? Well, that's interesting, the crisis in China. So you might be able to characterize the market, the stock market in China, as a bit of a crisis. It's lost more than half its value. We talked about that last week. But is there really a crisis in China? The whole stock market thing is being driven by concerns about China growth. China GDP had been in the double digits. Earlier this year, the projection was 7%. Now it's been cut in half, down to about 3.5% GDP for China growth. By comparison, so America is the world's largest economy. Our GDP growth projections for this year are 3.7. And that's been revised upward, and that caused some optimism and some thinking that maybe the Fed would cut or increase interest rates sooner in an attempt to be out ahead of inflation. The world's second largest economy, their growth rate was projected to basically match ours, and that caused the stock market to tumble. What does all that mean? I have no idea. I'm not a fundamental investor. I don't try to take news reports and economic projections and try to figure out what's going to happen in the stock market. This discontinuity between the headlines and the numbers and what the markets are actually doing is the reason I'm so much in favor of technical analysis, of basing my trading and investing decisions on the realities of the stock chart in front of me. So let's take a look at some of the realities and get past the noise of the headlines. So here's the Dow Jones Industrial Average daily chart, and I've got this zoomed in really tight here to make a point. We just looked at all the headlines, and they were talking about the Dow tumbling and falling and crashing 200 points, 300 points, or rallying and all that kind of stuff. I drew this circle right here with the white line, the blue background, around the last 5 price bars. So this last week's price action all happened inside this blue circle. And I just like to draw a contrast between the volume of the headlines and what's really going on here. And I'll even zoom this out a little bit tighter, and you can see it kind of a better contrast. So now I've zoomed out, and we're looking at about 2 years worth of data on the screen for the Dow Jones Industrial Average. And this is the last couple years of a 6-year run up, and then we had the decline that we've been talking about. And here's this week's price action inside this, and you can kind of see in comparison to the overall trend and even the current downtrend, this price movement in here is really just noise. It really is just noise. And so we need to take the headlines with a grain of salt and understand their job is to draw attention, get people to read our article, and sell ads. Their job is not to give you investing advice. And we certainly don't want to base our decisions on the noise from the headlines. So, what is the reality of the market? Well, the reality of the market, I'll go ahead and take this circle off, is this last week we had, if you drew a line, there was a bit of a downtrend, but it really is just a bunch of back and forth noise. And I said before, I think we will get that. I think we will get some backing and filling, some back and forth, but we still are in a downtrend. That pattern is continuing. For it to really have to be over and for the market to go on and make new highs, it would have to come up and take out this high on this dashed green line here, which is at 17,568. And we've got quite a ways, and I do not think it will do that. I think it will continue to consolidate a little bit and then go on to make new lows down to the targets that I talked about 13,500 to 11,500 on the Dow. So that really is the market update. We can expect some volatility, may pull up. It may take out this short-term high here. That would not be unexpected go up. I don't think it will take out this high. At some point, it's going to reverse again and go out, take out this low, put in new lows. That's the forecast. That's the reality of what price action is telling us as we look at the various analysis tools. So that's what we have to look forward to. It probably will be volatile, and tough to trade in these kind of markets, and that's why we look at the realities of the individual charts. We try to go with the trend, but then find really good patterns on our individual stock patterns. We're still short on several positions like Ingersoll Rand, Caterpillar, Goldman Sachs, and those are doing very well. We're in solid profit on those. And I'm also trading an ETF called the VIX. It's a volatility index, and since it's been so volatile, that's doing really well. We're in solid profit on that. So that's really the outlook for this week. Expect some more volatility, but the bias and the overall trend is to the downside, and that's how I will be playing my trades. So look forward to your feedback, your questions, and shoot them over to me. I really like answering those and just hearing what you think. And stay tuned. We will keep you updated. Catch you next week. Thanks.